Good afternoon and welcome to the 731st meeting of the Economic Club of New York. I'm Barbara Van Allen, President and CEO of the club. The Economic Club of New York is known as the nation's leading nonpartisan forum for discussions on social, economic, and political issues. And we've had more than 1,000 prominent guest speakers appear before the club over the last century, actually more than a century now, and have established a strong tradition of excellence, which continues up to today. I'd like to extend a warm welcome to students joining us from the NYU Stern School of Business, Columbia Business School, and Mercer University, as well as members of our largest ever class of fellows, a select group of diverse, rising, next-gen business thought leaders. As a reminder, applications for our 2024 Fellows Program are now available on the club's website. It is my honor to welcome our special guest today, Paula DiPerna. Paula is the special advisor to CDP North America. She's a pioneer of strategic global environmental and philanthropic policy and a widely published author and commentator on contemporary issues. Paula serves on the board of advisors of Global Kids, whose mission is to develop global citizenship. The Circle of Advisors of Rachel's Network, which links women philanthropists who have environmental interests, and the Board of Directors of History Makers, a unique oral and video archive of profiles of African American leaders of all sectors. As a leader in the development of carbon markets, Paula served formerly as president of the International Division of the Chicago Climate Exchange, the world's first cap-and-trade system covering all 6 greenhouse gases, which also launched the Taizhou Climate Exchange, China's first pilot carbon market. She also served formerly as president of the Joyce Foundation, a major U.S. philanthropy, and as a writer, co-producer, and vice president for international affairs for the Cousteau Society. Today, as part of our author series, we're here to discuss her latest book, Pricing the Priceless, the financial transformation to value the planet, solve the climate crisis, and protect our most precious assets. The format today will be a conversation with club member and former board member Abby Joseph Cohen, who we're honored to have moderating. Abby is a professor of business at Columbia Business School and retired partner at Goldman Sachs. Time permitting, she'll take questions from those of you participating in the chat box. As a reminder, this conversation is on the record, and we well may have media on the line. Without further ado, I'm happy to pass this time over to you, Abby.
Barbara, thank you so much. Thank you for that warm introduction of Paula and myself. And as a former vice chair of the Economic Club, I'm just delighted to be back in this particular role speaking with Paula. The book that we're here to discuss was described by the Financial Times recently as one of the best books of 2023. And I have to say that I must agree. I very much enjoyed reading it. And I have to tell you, I was a little bit surprised. And Paula, please take no offense. But when I picked up the book, I thought it might be, another one of those dry books written from an economic perspective. And instead, what I found is that it was such a comprehensive look, discussion of the climate science involved, a discussion of, yes, the way corporations and the markets might be able to approach these incredible problems involving climate, but it was also a bit of a personality study, not just of your engagement, but the engagement of so many other people, particularly in recent decades. And so what I'd like to do is ask you to set the stage for us. If you could begin by answering 2 related questions. Number 1, why did you write the book? Why publish it now? But also set the stage in terms of describing what was the situation like, say, 30 years ago. Now, 30 years ago may be a long time with regard to financial markets. Obviously, it's just a blink of the eye with regard to some of the geological and scientific aspects of the discussion.
Thank you for that. And thank you to the Economic Club, of course, for that, for this opportunity and the lovely introduction from Barbara. And also just a pleasure to be on screen with Abby, legendary Abby Joseph Cohen. And I used to run down to Wall Street to drop in occasionally if you had a minute to just talk something mostly about carbon markets. So your leadership has just always been very important to me, and I'm delighted to be here. So, why write the book? I mean, one thing, I'm a writer, and I'm always passionately driven to use writing as a platform. And after so many roles, I have come to the conclusion that one of the big urgencies, it's like when you play a slot machine. If you get bananas, cherries, and lemons, you don't win anything. But if you get bananas, it's sometimes a jackpot. So in terms of your question, what's the jackpot is if science, policy, and capital run on the same timelines. We can't address climate change or any environmental depreciation problems if the science is not more on the same timeline as policy, giving policymakers an opportunity to really set policy that meets the geological and physiological and physical challenges, and then that allows capital to work also at a timeline that might be a little more patient than the quarterly call or some of the profit and loss timelines that investors have to face. So until those three are working more in harmony, I think we have what we have, which is three separate threads, more or less. So the first reason to write the book was to try to bring those three things to the table in harmony, as well as, and my conclusion was the only way to get that jackpot was to begin to price the priceless, begin to use the tools of pricing, not so much to price the asset and put a finite price on the atmosphere, but to begin to price the scarcity, the increasing scarcity, law of supply and demand, and begin to use the principles of pricing to try to bring these three things together. Now, and also it is sort of Paula meets environmental economics, because I am an explorer at heart. And for me, this financial arena was essentially, and almost always has been, new terrain. I won't say incognita, terra incognita, but almost. As to the 30 years, I was at the Rio conference. I'm sure some people online here were as well. I don't know if you were, but, Lou Preston, the head of the World Bank at the time, had gaps in his schedule. All the heads of state were there. All the advocacy groups were there in 1992. Jacques Cousteau and I got George Bush to go. All the presidents were there. The group of 77 was there. It was heavy on policymakers, but financial people were scarcely there. They just weren't there. And the head of the World Bank actually had his office call my office or call me and say, does Jacques Cousteau want to have lunch with Lou Preston? Imagine if today's head of the World Bank, probably you couldn't get 5 minutes with him. So 30 years ago, capital was not at the table. It wasn't playing this role. It wasn't really focused on anything to do with environment. And it took a long time. And I would say the catalytic event in part was the emergence of, I would like to think, CDP and disclosure, opened eyes by visionaries like Abby and others who began to see that the environmental situation was loaded with contingent risks and invisible costs and things that weren't being priced in. And so that's kind of where we are now, is how to price this stuff in and still stay within the framework of credible, financial structures.
Yeah, thank you for that introduction, and thank you for the kind comments. And I would basically say, if we roll forward a little bit in time, perhaps to only 20 years ago, what we saw, I think, is that there were more people waking up to the issues involved. So if we get to, say, 2004 and the UN meeting that took place at that time, you do see that a number of financial firms participate. I was very pleased to represent Goldman Sachs at that time at the United Nations and related meetings. But something else was happening. And I think you do a great job describing in the book that if you're not measuring something, it doesn't count. And we know that in finance, if we back away and not think in terms of climate for a moment, but if we think back over the years and say, well, before investors thought to include return on equity, ROE wasn't part of the equation. Before we began to think about quality of balance sheet, that wasn't part of the equation either when investment decisions were made. But something began to happen 20 years ago in terms of the collection of better information, better data. And I'm the first one to admit that a lot of that is an art form. But if you could explain a little bit more about the greater collection of information, not just about what's happening in the climate per se, but also the impact on corporations.
Yeah, well, the Global Compact, began to look at these risks, and even then was talking about, what's the timeline for return? Should it be 10 years less? Should remuneration of the CEO be tied to environmental judgments? And I think what's happening now is you have basically only outliers are not thinking about their climate risk and their disclosure. I mean, CDP has, 20,000 companies disclosing. You now have the SEC rule about to be announced in one form or another. California, the EU will be requiring mandatory disclosure as of 2025. That's already in law. And so there's momentum. What's still a bit missing, though, I think, is this idea of using capital in big ways to really get outside of what we now have taken as mainstream, which would be ESG investing and various tools that we've come to put together, and go beyond those to some of the things that that I talk about in the book, where the value proposition is aimed at this pricelessness, these services, these invaluable things that are not on the books at all. And we have to get them on the books. And so that's where I think, momentum is going now, or I'd like to think so.
Yeah. So Paula, you have a great deal of experience in things like carbon pricing, carbon taxing, discussion about cap and trade. And I would say that many members of the Economic Club are at least familiar with those terms and the basics. So what I'd like to do is to go beyond that to some other examples that you have in the book that people may not be familiar with, because they represent more innovative ways. Not that carbon pricing, carbon taxes aren't innovative, but other forms of innovation using the financial markets to basically get us in the right place. And there are three examples in particular in the book that I found really very striking. And one has to do with the use by the Puma company. We all remember their sneakers and so on, and how they tried to build a P&L, but a P&L that was linked to their environmental profile. Can you talk, Atessa, about that for just a little bit?
Sure, thank you. And I think that's a very important emerging tool potentially. So Jochen Zeitz, many people on the call may have heard of him or know him, and he endowed a wonderful museum of contemporary art in Cape Town, South Africa. So maybe he's, visually and broader minded anyway, but his innovation was his firm did their annual P&L according to the conventional usual methodologies, and the net revenue for the year was 202 million euros. And then he engaged, I think it was Sustainalytics, to look at the P&L from a different perspective, and if there were prices put on all of the inputs or all of the usages that Puma depended on to make their products, to fabricate the products or get the raw material, what would those prices, what costs would Puma be facing? So they used carbon pricing, and they used the average price in the cap and trade that year in the EU ETS, which was higher than in many jurisdictions where they were operating, but still they took the higher one. But other things were really interesting, like what would be a real cost of waste disposal? What would be a real cost of water if they were paying it? And remember, they were in different jurisdictions, so they averaged this always very credibly. What was the land use cost value of the land, that if it had been running cows versus growing corn for food, or if it had been growing corn for food, then to convert it to cotton for fiber for the shoes. So all these inputs had a price put on them that was very credible. And then the net result was that the cost would have been 145 million euro against the 202 that they had in revenue. Well, that's a substantial chunk out of the revenue, leaving their, P&L position wildly different. And imagine if everybody did that even today as an indicator, not necessarily, it kind of quantified that hidden risk that people would argue and do argue that the whole GDP is based on these services. And so if the GDP is 100 trillion annually, nature services are worth at least 100 trillion, but that subsidy from nature is nowhere recorded. And so the P&L is a wonderful, I think, example. And then going beyond that, if you'd like, the things in the book, one of my favorites, which I just was talking about in Portugal and just spoke about at the Rockefeller Foundation, is the Forest Resilience Bond, which, speaking to the students who are on the call, this was the brainchild of 4 students, graduate students at Haas Business School at Berkeley a number of years ago. And I was in Bellagio at the Bellagio Center doing research on the book. And these guys popped up, 3 guys and a woman, at the Milken Institute talking about this idea. And I was just talking to the COO now of the company. And he said, yeah, we knew it was a great idea, but we didn't think somebody would want us to actually do it. And so they went from idea. It's also a reason I wrote the book, back to the first question, is to get things that are theoretical into practice. So what is the FRB? The FRB raises capital. In this case, their first effort was 2 million from foundations expecting a return, but a concessionary return, and 2 million from private investors expecting a market return. And they took a pilot area of forest in Lake Tahoe, understanding that the way to resist wildfire includes resilience in the trees themselves, which means they're moist. They're not covered with dry grass. There's not a bunch of tinder at the bottom. How do you do that? You put firewalls. You have to almost tend the forest like a rose garden, but that's very labor intensive. Who's going to pay those people? So in California, there was so much wildfire that the budgets for the prevention were being eaten up by the need to spend the money to put the fires out. So this is a forward-looking instrument that raises capital upfront that is then deployed in these prevention methods, and the beneficiaries repay the loan or the bond, if you want to call it a bond. And the beneficiaries are an incredibly diverse group of people, way beyond what you'd ordinarily think. So, for example, not just the people or the hotels that are near the forest that you don't want to burn down, but the hydropower company in the watershed that needs as much water as possible going over the dam and feeding into the reservoir. And their avoided cost would be, if they have enough water, they don't have to buy power from somebody else. The local insurance, the AAA local insurance, they were very keen to become involved because they wouldn't have to pay as many claims. So this structure was the brainchild, as I said, of these 4 students. They implemented number 1 with $4 million. And what this is pricing is the pricelessness of the resilience, not the value of the trees as timber, but the resilience of the trees, which is a service, an ecosystem service that nature is providing and not paid for. So they've gone from the first bond of 4 million to a second one now of 25 million. They also have a $25 million innovation fund, which is pooling capital, and they're building a portfolio to aggregate smaller projects for the benefit of investors. And this is highly investable. Not only is it investable, it's transferable anywhere in the world. And I love this one. I love them all.
Yeah. And so this is something that truly can be scaled. And of course, it's extraordinarily timely given the wildfires, not just in California and Canada, but really all over the world now.
Yes. In fact, I was just in Portugal. I may have mentioned that. And we're going to have a call, I think, next week about precisely this. So I'm thrilled with that. The people running the forest fire protection in Portugal are very keen to know more about this structure. The other one that's, I think, also very important is the coral reef insurance, which is a different mechanism altogether. It's a parametric insurance tool. Everyone knows the importance of the insurance industry and the reinsurance industry and the risks and costs they are facing from extreme weather events. So the coral reefs up and down Mesoamerica are buffers to the coast, and yet we insure the coast and all the valuable property on the coast, but we don't in any way insure the buffer itself, which is largely often coral reefs. And coral reefs are dying all over the world for many reasons, notably temperature rise of the ocean, but there's still about half of them that are structurally sound. Mm-hmm. So what happens during a high hurricane event? If the wind hits a certain speed, that's considered a triggering event. And there's a high degree of correlation between wind speed, wave thrust, and coral reef destruction. And being a Cousteau alumna, though not a diver, I love this one too, because what this enables, so the premiums are paid by the organizations that protect or are in charge of the reefs in any given country. And if the wind hits that speed, it automatically triggers the payment of the due amount to the policyholder, and that enables them again upfront to put diving teams into the water immediately after the storm has calmed. And I never knew this, but you can actually go down, take a drill, rope, buttons, cement, glue, and put Humpty Dumpty back together again. And so it's extraordinary to think about being able to insure the reefs as if they were bridges, as if they were tunnels, and fix them immediately after they are shattered so they can fight another day. And in the meantime, the coral reef scientists are trying to breed more coral that's resistant to water, to higher temperatures. So it's a kind of a race against time. And then the third one that's discussed in the book is the rhino bond, which is underwritten by the World Bank and GEF. They take all the risk, but all the investors in that are commercial investors who want, the AAA guarantees of the World Bank. And this one, again, upfront money to two particular parks in South Africa where their budgets were decimated for poaching and so on, patrolling due to COVID and loss of revenue from tourism. So this brings money to them so that they can beef up their anti-poaching, train local people to deal with the rhino, re-fence so the rhino don't rampage all over the farms, all these things that have been postponed and caused the rhino populations to be shrinking either due to poaching or general dying off. And so all three of these, again, I'm not an economist and probably people would challenge this, but all three of these, to my mind, price the service of nature. They price this in this underlying value that otherwise we don't see. We see the rhinos and we can price the tourism revenue, but all the other things the rhino provides, we don't value or we don't put on the books. So these are the tools that are what form the heart of the book. And, as I say, I think all of them could be scaled in one way or another.
Yeah, so important because as you note in the book, we really are facing these issues on a global basis. And so I'd like to segue to a question about the global environment here. We often talk about China's role with regard to future environmental degradation. The world's second largest economy, the world's largest greenhouse gas emitter at this point. So can you speak a little bit about some of the approaches China is using? So for example, their focus on things like measuring intensity. We like to look, for example, at pollution per unit of GDP, and they don't look so good on that basis, but are improving. So how does a large nation like China go about trying to improve their performance in this regard?
Well, I mean, China will do what's good for the Chinese economy. And so, number one, they've understood that green finance and emissions reduction in general is going to be a growing business, and they want to master it. So I would say number one, that's what drives them. You and I both know in common, I'm happy to call him a mentor of mine, Richard Sandor, and Richard, as everyone probably knows, was formerly the chief economist of the Chicago Board of Trade, father of financial futures, and he was at Rio too. He had been invited by the UN to talk about whether cap and trade could serve the purpose of reducing greenhouse gas emissions, having advised the US EPA on the SO2 cap and trade system, which was quite a bit more simple. But Richard, being Richard, said, sure, we'll try it. Let's try it. So that's what led to creating the Chicago Climate Exchange. And then Richard and I decided that why not try to set up something in China? So lo and behold, the first partner we got was PetroChina, gigantic state-owned enterprise. I think the largest company in China nominally by market cap at the time. Now, why did they do that? Because they saw the handwriting on the wall. They wanted to understand carbon pricing. They were potentially interested in oil trading, which they weren't doing at the time. And what I remember is during the contract negotiations, it would be long table, plenty of teacups, beautiful setting. Richard, me, and our interlocutor, the three of us, sometimes our lawyer, so four of us. And then we had always exactly the same number of counterparts on the other side of the table, but behind them, like 40 other people. And I used to wonder, like, who are these other 40? Turns out they were students. They were junior staff. They were being trained in carbon trading, carbon pricing, how to negotiate with Westerners, building what they now have, which is an entire generation of well-trained people who understand and want to move forward on certainly on the business advantages, and I would argue probably the moral advantages of green finance and using market tools to advance environmental protection. So they started a cap and trade. We started the Tianjin Climate Exchange. That, was kind of a little bit of a rocky deal, but anyway, we got it going. And now they're flying, and it would be the largest commodities market in the history of the world if it were fully operational today. And it would be fully operational if we had not pulled out of the Paris Agreement, because at that point, the Chinese chilled down their momentum and their speed, but there had been a handshake at COP21 between the President Obama and the President of China to both clean power plan on the US side and the cap and trade on the Chinese side. So the intensity measure, which, is the holy grail. Can we continue economic growth while decreasing emissions growth? That we can't do that. We can't deal with climate change because you need economic growth for people's benefit. So what they're doing is using their intensity measure, which is tradable and which you have to go through the absolute tonnage arithmetic to get the intensity measures. But while they're at it, they're also learning to the nth degree about the efficiency of any given product, which means that the energy efficiency at the least, and probably other inputs, means when they market those products, they actually do know if they're the greenest in the market, and they actually do know what numbers back that up. And so once again, we would never accept a market that's trading intensity tons, but they are, and they're getting double benefit. And our markets are very fragmented. You have California very much on its own, Reggie very much on its own. When we hit the heyday of CCX, we had more emissions capped by far than the two of those if they went together today. So it's urgent to get hooked up again with China on the cap and trade side, so we could have some semblance of an international carbon price, which would be revolutionary and I think transformational in the end.
Yeah. I have a couple of more, let's call them mechanical or technical questions for Paula, but if anybody who is listening and watching today have some questions for her, please put them in the chat and we'll take a look at them as well. Paula, I wanted to get back to this idea of data. Obviously, we know that corporations require data to manage themselves. Investors want data so they can do proper assessment, not just of risk, but also of opportunities. Can you describe, please, what has happened over the last 10 or 15 years in terms of data availability, not just in the United States, but in other places as well, with regard to impact on the environment from industrial activity?
Well, I think if you read, for example, the Dasgupta review, the economics of biodiversity, there's a long litany of depletions, whether loss of mangroves, loss of fresh water, nation by nation. The World Bank has the Wealth of Nations, which is almost an almanac country by country of loss of, if not physical resources, services. So that's all negative. And then you have, very many of the major investment houses doing their own research and quantifying loss of fisheries. There's just loss anywhere you look almost. Now, on the other side, you also have an extremely promising set of science and data gathering on the ecosystem services side. There's a database called the Ecosystem Service Database, and there's something like 5,000 studies banked in there, which are very local studies where there's a credible quantification of the value, again, of those ecosystem services. So while on the one hand, you're losing mangroves by the hundreds of acres on the one hand, you're also able to price the services that mangroves provide to protect what's left. And what are the services? Filtration, nursery of fisheries, buffering again of the coast. The whole government of Myanmar fell down 10 years ago because Nargis, the cyclone, just went right through because there were no mangroves to hold it back. And that enraged the people, and the junta had to step down. They're back, but you can say that there was a step to democracy because mangroves had been decimated. So this is happening all over. But I think the absence of data, there's always gap filling, and you often talk about what's priced in and what's not, and why it's not priced in. That if you're not thinking about it, how would you price it in? So its absence may or may not be indicative. So I think data is certainly there and good enough to really, if you go back to the book, stake a claim and make some of these proven tools and take them to scale. I don't think there's a risk of absence of data. Perfection of data, maybe not. But I don't know anybody on Wall Street who acts on perfect data. Do you?
No, but we pretend we do, or at least we try to. And going back to that topic, you mentioned before that the SEC now requires disclosures. And my own research basically indicated that even before that requirement, about 85% of the companies in the S&P 500 were providing disclosures voluntarily to the SEC. And those disclosures were fascinating to me because many of them in the early days were on the negative side, basically companies disclosing environmental damage that they had inflicted. And part of that might have been liability protection, so no one could come years later and say, you didn't tell us about that. But as we take a look at the more recent disclosures, many of them are actually on the positive side. Yes, there's still some damage that's being done to the environment, but many of these same companies are also saying they've developed products that they can now sell. Maybe they are water filtration systems, or they're something else that can help clean up the environment. So there really does seem to be much more attention by the corporate sector in the US, in Europe, and we also see it especially in places like Australia that has been dealing with the coral reef issue for a long period of time. The other thing that I'd like to ask you about has to do with ESG types of investing. This has been a very controversial area. And before I discuss it, I want to point out that Paula's book is totally apolitical. Talking about solutions that don't involve politics and typically don't involve intrusion by the government. But one of the things that we have seen in the United States, for example, has been that certain political entities are basically saying ESG should not be a factor in determining portfolios. And yet we see the marketplace going in the opposite direction. Lots of inflows into ESG sensitive investing portfolios by endowments, by many pension plans still, and also by private investors. Individual investors, when they're surveyed, say that this is one of the areas in which they are most interested to expand the exposure of their portfolios. Paula, would you like to speak about that particular issue?
Yes, I mean, thank you. I feel, again, back to the perfect, the SIF, the Sustainable Investment Forum, has been tracking the number of dollars screened for ESG for at least a decade, and it was always going up. And then all of a sudden this year, I think it went from $1 in $3 invested in the United States, screened in some way, either an exclusion or a proactive inclusion. In the ESG front, it went from 1 in 3 to 1 in 8 because of a changing of the labeling and a changing of the boundaries and an anticipation that the SEC was going to come down hard on labeling. So, and then Barron's had a headline, half the amount of money being invested in the United States is no longer being invested in ESG. So half the ESG portfolios have been halved. That's not really true per se. So shifting of labels isn't necessarily shifting of anything else. But, I think it's cognitive dissonance. Again, politics aside, if you are in the very day almost that the governor of Florida and the state legislature issued a command that the Florida pension fund could not invest in anything remotely resembling ESG that carried any kind of a label like that. On almost that very day, one of the major insurance companies announced that they would no longer write flood insurance in Florida. Now, partly why I think we have that cognitive dissonance is because the average person is not paying attention necessarily to the directives given to pension funds or the directives that have become political. And firemen and teachers live on the coast. And when they can't get flood insurance and find out that their pension fund also cannot invest in, let's call it flood insurance preparation, that's a very big disservice to them. So I think, and to your earlier point, companies have been moving faster than policy. Policy's been behind, and I would argue it's probably even now behind the actual ability to catch up to the problem. Mm-hmm. So capital has to almost go further and faster than it would have before. But I think we have to go back to 2004, to the UN, the Global Compact, to the Paris Agreement, however much it's a mixed bag. People want to be at the table now. And it is true that if you're not in this arena of ESG, it's hard to make a case to your clients. Everybody I talk to says their clients want to talk values and want to talk choices, even more than performance sometimes. Not to say that they don't want performance, but people are very, very interested, small investors and big investors. And I was just talking to an investor who heard me, one of my talks, and says they have an ETF based on biodiversity components where you can invest $25. It's a very super retail instrument. So I think that there is momentum from client side, advisor side, wealth manager side, high net worth individuals. And we just have to keep that momentum going because nobody on earth, I don't think, could argue that there aren't risks inherent in every economic activity today based on environmental depreciation, what Gupta calls depreciation. And that what happens to your house if you let it depreciate? Sooner or later, it's not worth anything. And we're at that point. I just heard something last night, a wonderful talk by Helen Greshke, who's a physicist, an oceans physicist, wrote a beautiful book called The Blue Machine, which I recommend. I mean, her descriptions of the ocean as a structure, as a system, where all these things are happening, driving life on the planet. And we don't think about it. Even I, as a Cousteau person, never really understood the degree to which the ocean is an engine for transferring heat to mechanical action. So if money starts to recognize that, we have a good shot.
Yeah. So as a financial markets person and as an economist, I'm so glad that you raised the issue a few minutes ago about greenwashing. That is corporations and portfolio managers who are basically talking the talk, but not really walking the walk. Mm-hmm. And what you were referring to before was the SEC coming down or threatening to come down hard on those money managers who said they were managing ESG-oriented portfolios, but they weren't really. They just put that label on it. And I, for one, am always happy when markets run more efficiently. That is, if something is ESG, it says it's ESG, and it doesn't say something that it's not. And the other thing that we're seeing is cleaner data from corporations themselves.
Right.
And as a consequence of this, we have better input to go into valuation approaches of a more standard nature, sort of the financial valuations that we look at when we make portfolio decisions. And we also have better information in terms of the performance of those funds that really are ESG centric, as opposed to those that said they were ESG centric. And in many cases, we see that there, in fact, has been good performance on the part of these funds. And I'll just make the following observation as one of my last comments before I leave it to you to kind of wrap up some of the thoughts that you'd like to leave our listeners with. And that is that when you have basically an efficient market with good information, the right decisions are made. And 20 or 30 years ago, when very few investors were looking at many of these factors that we now almost take for granted as being critically important, well, they weren't priced, right? They weren't priced into the market. But now that we have so many investors looking at energy efficiency, environmental impact, and so on, we do see that these areas are no longer inefficiently priced in the marketplace. So, for example, within a particular industry, we do see that the cleaner companies are often rewarded with higher PEs and lower cost of debt capital. And this is something that was hard to pinpoint in earlier years, but it's now showing up more. So I think that this is, while you state it in the book in such beautiful terms, in terms of scientific systems and geological systems and so on, in my narrow perspective as an investor, I also see it in terms of financial and corporate performance terms. So let me turn this back to you, Paula, as we begin to wrap up.
Well, thank you. And I mean, I think that's far from narrow. I mean, that's kind of the point. There's trillions of dollars in the economy, and what's it for? And I think part of what we're trying to talk about is how to shift those trillions into some of the value propositions and tools that we've been talking about. So thank you so much again, Abby, for taking the time, and to the club for having me, and happy to follow up at any point with anyone who's interested.
Okay. Paula, thank you. And Barbara?
Well, yes, thank you both. This was a great conversation. I think a lot of those listening, if they haven't read the book, they will be. And so thank you for giving us your time today. I'm pleased to report, as always, that we have many great speakers still ahead this fall. And as always, we encourage our members to bring guests to our events. Next up is November 6th. We have a webinar panel devoted to Harry Markowitz. And that will feature Sandra Gerber and Glenn Hubbard, as we know, a former chair of the club, and Anurag Pandit. So we're excited about that. On November 7th, we'll be hosting Erica James, the Dean of Wharton Business School at Penn. She'll be in a conversation actually with John Williams. So we look forward to welcoming her. November 15th, we have a lunch with Adrienne Harris, the superintendent of the New York State Department of Financial Services. I know those in the banking sector are very familiar with who she is, and we're delighted to be welcoming her. On November 27th, we're going to bring back David Petraeus, the well-known general, U.S. Army retired, and he will be in a conversation with Marie-José Kravis, and he will speak to the situation in the Middle East as well as Ukraine, so that should be quite timely. On November 30th, we have Bill Lewis, who is a partner at Apollo Group Management. He is obviously a club trustee as well. So we look forward to hearing from him. And I believe the invitation's going out today for Bill Gates, who will be joining us December 7th, and will receive the Peter G. Peterson Leadership Excellence Award. And that will be the only award the club gives, and we give that annually. So we're excited about that closing dinner. We'll also recognize the winners of our Innovation Challenge at that event. And that'll be followed by, on December 11th, we will be having not only our holiday party for all of our members, which is complimentary, we'll also be hosting a final luncheon featuring Brad Jacobs, the executive chair of XPO Logistics, who during the supply chain situation spoke earlier, and I'm sure will be a fascinating conversation around his new book. So lastly, as we always like to do, I'd like to recognize our members of the Centennial Society joining us today, as their contributions continue to provide the financial backbone of support for all that we do at the club. So thank you all for joining us. Many thanks, Paula and Abby. And we hope everyone has a great rest of the day and great rest of the week. Thank you.